UGLY. Do stocks have an alibi for this wretched performance today? It's Thursday, August 24th, 2023. This is Overtime. I'm your host, Chris Vecchio, head of Futures and Forex here at tastylive, joined, of course, by my co-host, Mr. Ilya Spivak, head of Global Macro. Ilya.
That's about right. That's about how they look today, and I'm not mad at them.
I know you're not mad at them. The S&P 500 decided to kiss that little 4480, 4500 zone, and we couldn't clear that hurdle. It's a bad day for stocks. S&P down by 1.5%, NASDAQ off by 2.44%, Russell 1.40% lower, and the Dow Jones off by 1.17%. Outside engulfing bars, bearish key reversals, outside day reversals, whatever you want to call them, they're here. They're on our charts. And they're not fabulous, as it were. But we're going to take a little bit of a different route on today's Overtime. We're going to be bringing in Dylan Ratigan, joining us from over the pond, across the sea in Milan, Italy. He'll be appearing with us on Wednesdays here on Overtime moving forward. Dylan, it's a pleasure to have you join us on Overtime for the first time.
Welcome. I've been waiting for the invitation for some time. I don't know why. What took you guys so long?
It is my fault. I blame myself for those poor screen tests for the Zen Capitalist, but I think we're moving past that, and we're going to have a good session here. We're using Zoom. We're not using Riverside, so my audio and camera will work. Dylan, this is obviously a very important week in the macro world. We do have this Federal Reserve Policy Conference the next few days, Jackson Hole, Wyoming, the Kansas City's annual symposium. I've been listening to some of the media interviews out there with various reporters who are on the scene. And you have some experience working in financial media, of course, from your time at CNBC. Do you find that this Jackson Hole, with that keen, financial markets, politics, philosophical perspective that you bring to the table, do you find that this is one of those meetings that matters less than in years past from your, outside observer's view now?
Not necessarily. I mean, I think that there's a very strong parallel between the NVIDIA earnings cycle that we've all just sort of been put through and what we're about to go through in Jackson Hole, insofar as everybody was expecting NVIDIA's numbers to be sensational, and everybody's expecting the Fed to stop raising rates. And so it's sort of like the deviation, the only thing that's in play with financial pricing is, will the Fed surprise everybody with some comment saying, well, maybe we will raise rates again, or maybe, like some sort of tea-leavian indication of a desire to be more hawkish, which would be obviously probably poorly received. But even if the Fed does what they're expected to do, the same way NVIDIA did what they were expected to do, it also might not be great for the markets. It's one of those things where things are only as relevant, and I know that you know this, Chris, better than most, but things are only as relevant as they are deviant from what's expected. Mm-hmm. And so Jackson Hole is completely irrelevant to the degree to which Jackson Hole brings no new information to light. And Jackson Hole is hugely relevant to the degree to which somebody decides to say something fantabulous about, policy. You kind of always, I'm just thinking, you mentioned like whether it was my time at Bloomberg or time at CNBC, I always wanted to believe that because they're fishing and in blue jeans, that they might be more, that you might get more information out of them, because of their guard, you're not inside of the mantle of the boardroom and why, like the authority of the office is, they're not wearing the cape of the authority of the office in the same way. They're just like some people fishing. It reminds me of when at Bloomberg, the Saudi oil minister, who was like all the Wall Street Journal, Reuters, Bloomberg, Dow Jones, everybody had a specific reporter assigned. Your job is just to cover the Saudi oil minister and live in Riyadh and all this jazz. And the Saudi oil minister absolutely loved this situation. I mean, the ego was just over the top because he had all the world's financial news agencies dedicated to just paying attention to him and what is he saying and what is he thinking, and sort of very same as the NVIDIA CEO or the Jackson Hole crowd. And so he decided that he was a big jogger runner, that he would only make comments on his views on Saudi oil production while running at 6 a.m. So if you were a financial reporter and you were not willing to go running with the Saudi oil minister, you would not get the assignment. Like the bureau chief in New York would say, "Are you a runner? Are you willing to wake up early? Will you go and run every morning with the Saudi oil minister to find out what he's going to say?" So there's sort of an aspect of cat and mouse, and I'd like to think that the Federal Reserve governors are less coquettish and sort of absurdist with their power to say things. But, at the same time, like maybe if you're willing to go fishing with them and if you catch a trout, they'll really tell you what they think about rates. I'm hopeful that it'll be more. The news is always more interesting when there's news. So I'm always hopeful that there'll be news out of Jackson Hole and that Powell will basically say something that no one is expecting, if only because of the news value.
I think about the timing of all this, right? NVIDIA's earnings, you can make a case blow everyone out of the water. They show how quickly we're shifting to demand from the two GPUs from CPUs. And that means some of these legacy producers like your Intel are just going to be left in the dust. Even AMD, which has promised to make GPUs down the line because they haven't manufactured any just yet. NVIDIA is continuing to just suck up all this market share right now. That not necessarily isn't new information. Ilya and I have been having a back and forth about this, both on video and in written word here. We actually just published a little bit of a debate piece to the tastylive Traders blog today about whether or not Jackson Hole matters to markets. Ellie, I'm not going to speak on your behalf. You can elucidate, Dylan, on your perspective. But my view is I look at the options market and we can pop on over to what's happening here in ES U3 today, which you can see that really ugly outside engulfing bar up against that former resistance that we've been watching. And we'll pop it over to U3 here. The options chain isn't pricing in a significant move for tomorrow. I mean, 34.5 points through the end of the day. That's less than 1%. Even through the end of next week, less than 2%. The price action today obviously speaks otherwise. People are perhaps concerned about this. Yields are ticking up across the board. So I don't think it's going to be something huge. It's not going to be a deviant event. Powell and co have no reason to say anything to surprise markets. The effects of monetary policy are working their way through. Ilya, perhaps you can shed a light as to why you think I'm wrong.
Absolutely. Absolutely. So first of all, I completely agree with Dylan's perspective that market volatility comes when expectation and reality differ. If they don't differ, there is no volatility. There's nothing for markets to price in. There's no reason for things to move. This works really well when you're talking about numbers. So CPI is expected to be X and is Y, or is not Y, is X. There's movement or that there's not. Earnings are this or that. But GDP number is this or that. When we're looking at the Fed, and in particular this, which is not a policy announcement, we're not going to get a rates move. We're not going to get any kind of fiddling with any of the levers. We're going to get a kind of more abstract, more academic sort of thing, which is kind of like a lens tuning exercise, where the Fed basically comes out once a year and says, here's the lens through which we see things. Now, if you want to understand what our reaction function is going to be to incoming news, you tune your lens like this. Now go forth and tune. So I agree with you, actually, that the Fed is not going to say anything meaningfully different. I think what may be different is how the markets take it. And this is where you take an adage like the one attributed to Keynes. Markets can remain irrational longer than you can stay solvent.
Apocryphal, by the way. There's actually no evidence he ever said that.
Right. You can take the more pointed version of this from the great Ira Harris, who says if you're right at the wrong time, you're wrong. The flip side to both of those statements, which I agree with wholeheartedly, is at some point, even if you were right at the wrong time, it is the right time at some point. If the markets can stay irrational longer than you can stay solvent, they do eventually become rational. So what that means essentially in the context of these statements is the markets can ignore a thing for a long time until they don't. And what the markets have been ignoring for a long time here is that the Fed has been saying these same things, saying, look, we told you already, we're focused on inflation. We're going to keep beating this thing until it's dead. And we don't worry about maybe needing to trigger a recession to do it. In fact, we are kind of surprised that the unemployment rate hasn't gone up. We think it will and should. So you look at that and you say, okay, well, why haven't the markets cared and why should they care now? Because now, even just this week, we saw them care. The PMI numbers came out and they were awful, just awful. In particular for the Eurozone, which is almost certainly in recession now. The numbers out of China have been terrible. They've been coming apart at the seams. So what's left to drive global growth? Really just the U.S. of the three kind of main levers around which all the other economies sort of circle and sort of are vendors for. So you look at that and you say, okay, well, who's the Fed aiming this cannon at? The last leg upon which the stool of global growth stands. So that's why you care. Because if the Fed kicks that out, we're in a global recession because there's nothing else.
But Ilya, don't you think that, the expectation is the Fed is done or near, maybe
right.
They'll do another quarter. I mean, it's over.
Sure.
I look at the rally in the first half of this year, the core aspect of the rally obviously being, super tech, AI, whatever, but then the second stroke in the engine there is the Fed's done raising rates for the second half of this year. And that the unexpected event is some tweaking of the lens. I like your metaphor where this is sort of the lens tuning. These are the 10 variables that drive the way we set the lens. So you can now set your lens and look at the same data we're looking at and pretend to be us, kind of a thing. But I feel like the surprise tomorrow is anything that suggests that they're not done.
I agree. I think that comes in two ways, though, because the market is now baking in about 100 basis points of easing next year. So you can be done, but if you start to shave that off, let's say you drop 25 to 50 more basis points.
You're saying you're done, but you're not easing as fast.
Exactly.
Meaning relative. I'm talking about all the expectations.
Exactly.
Yeah.
Exactly. So the implied policy path basically shifts to a more hawkish setting, not necessarily because we're going to get another hike, though now the odds are over 50%, but you switch how much easing you're going to have and maybe wind that down to a significantly smaller margin.
Yeah. I mean, Chris, I interpreted today's sell-off as much more as sort of exhaustion from the super tech experience, emotional and financial. Did you see this, Chris, as anticipation of Powell than in sort of NVIDIA hangover today?
Well, consistent with my view that, the bond market, when you look at pricing, doesn't really think tomorrow's a really significant day. 0.83 points in terms of a movement in ZB, that's going to work out for less than 1 whole point there in the long bond. I see this more as just profit taking. I mean, if you've been an investor in NVIDIA this year and you just saw $500 a share, why on earth wouldn't you take some profit? This is, going back to 2016.
The whole thing, it's Apple and the whole NASDAQ 100 has just been like an absurdity.
It has been, and valuations are certainly a concern for longer term investors right now. This whole rally that we've seen since October last year has basically just been one gigantic multiples expansion, as it were. But I also think that we're in like this weird time of the year where it's the end of summer. Kids are going back to school. We have a Fed event tomorrow. Labor Day is around the corner. Do you really want to be holding the bag right now? Why not cash in some of your chips. This is also a really seasonally unfriendly time of the year. I think that we're going to be going through more of like a sine wave type of market where we go up, we go down, we bounce back and forth in ranges for the next few months. There's, concerns about Europe, concerns about China, but the U.S. economy is still growing very fast. The Atlanta Fed GDP Now growth tracker today was upgraded to 5.9% for the third quarter. That's searing hot. That's in real terms too, so adjusted for inflation. Not something the Fed had on their bingo card, and I don't think most market participants did. People were pricing in that recession, or at least writing down a recession in terms of their forecast. So for me, yes, the technicals are daunting. It's not what you wanted to see after a day like yesterday, after the bottoming efforts that we tried putting in earlier this week. But I just don't know how Powell's going to deliver something that's above and beyond the expectation. We already see, as Ilya points out, November, there's just about a 52.5% chance of a 25 basis point rate hike. One of my favorite stats I repeat ad nauseum is if you go back to 1996, anytime the market's priced in at least a 55% chance of the Fed doing one thing or the other, either a rate hike or a rate cut, they've done so 100% of the time. So the market is effectively at the point where we have priced in another rate hike. So how much more pain can that actually bring? I think the big pain point for tomorrow would be whether or not Powell suggests that it's more plausible for September. But we are in the territory where one and done is likely the outcome, and rate cuts probably don't start until June next year, absent a complete meltdown in Europe and in China.
I mean, Ilya made an interesting point, because I think people are being, and I'm obviously biased just from proximity, which is meaningless. But I think people underestimate just how disastrous the sanctions from the Ukraine war have been for Germany and Italy and Western Europe. I mean, and so it just goes to Ilya's point relative to the three legs of the stool. The Germans are just got destroyed by the American sanction regime.
Well, Germany also shot themselves in the foot by shutting off their nuclear power plants.
I mean, what are they doing? There's layers and layers of it, but the point is, I guess it does come down to will the Fed have to really? Is there a risk of a recession in the United States? Because if the United States is the only leg standing and the Fed is still swinging the axe, that's a problem.
So that's actually a good transition to where we should go next. You are across the pond in Europe. Italy has a new prime minister, Giorgia Meloni. Their economy has been slowing down. The broader Eurozone economy has been slowing down. It feels like we may have entered a new area of uncertainty with respect to the Ukraine war. Now that Prigozhin, or we should say Prigozhin out, has been carted off to the morgue. And as just a quick aside, I saw some people taking issue with my commentary yesterday about Russia. Two things. One, if you're the kind of person who posts on Twitter about loving Elon Musk for free speech, how dare you try to censor what we're saying here on the show? You left your clown nose and wig elsewhere. Also, this is free programming, so feel free to turn it off at any point in time. Going back to the main point of what I was saying, Dylan, though, Europe seems to be in a much worse situation than what we're dealing with here in the United States. For lack of a better phrase, what's the vibe over there right now? Is there just a ton of concern about these sanctions continuing to bite and drive in a deep recession?
Yeah, there's a befuddlement, confusion, and resentment in general with the United States.
Really? With the United States? That's interesting.
Mm-hmm. Yeah.
So how much worse does it get? Are we thinking that this winter could be a winter of discontent for Europe? High inflation again?
Sure. I think Germany is particularly prone to potentially. I mean, Germany is not happy, and it's not that Germany has a point of view on the conflict, but it's that Germany has a point of view on prioritizing itself and their own survival. Like my sense anyway is that the Germans are like, why should we be forced into all of this economic pain and suffering? How does that help solve the Ukrainian problem? Or how does that help solve the conflict between the United States and Russia?
I mean, it raises an interesting question, right? Because in pointing the finger at these sanctions, you kind of have to ask, okay, well, ostensibly, these sanctions are supposed to hurt access to things, make things more expensive, and thereby hurt the German economy, right? Things where Russia is the top exporter have fallen in price, not risen. So natural gas has fallen like a rock, much more than other commodities. Crude oil has fallen like a rock, much more than other commodities. Wheat, same thing. Potash, same thing. And this is because the Russians are flooding the market, because they only have so many outlets through the sanctions where they got a hole. And so they're trying to raise the money where they can and keep market share, because the long haul suits them. They have more people than the Ukrainians do, and that's how they've won the two wars that they care about. You ask a Russian person, as I am, which are the two things that come to mind as Russian military victories, and it's Napoleon and it's the Nazis, and both of them are wars of attrition. So you look at this and the Russians say, okay, you know what? We're going to dig in here. We have more people. We need to keep market share through this period of time because we have to raise money. So we're going to undercut everyone. So the prices on all of their key things are collapsing. Where's the pain for Germany from that?
Right, but the issue is not, you're right on the pricing, but what's happened is India stepped in to buy because their inability for Germany to buy directly. So India steps in, they buy the cheaper crude oil or whatever the fossil fuel is. India then refines it into diesel or whatever it is and sells it back at 3 times the price to Volkswagen, Daimler, Benz, and Porsche. So now the Germans are buying the same commodity that they've always been buying. There has been no supply disruption whatsoever. They're just getting jacked on the margin while the Indians make the profit, gouging the Germans to sell them back the same oil that they were buying before the war at 1/3 of the price. My point, the thought that occurs to me, and I recognize there's layers and layers in this, so I don't want to be too cavalier with any particular statement, but for the Russians, this is an existential situation.
Of course. Absolutely.
For the Ukrainians, this is existential.
Absolutely, yeah.
For the Germans, this is becoming existential. For the Americans, this is not existential. You're in a situation where the stakeholder in the negotiation with the most primacy, the United States, is the one with the least skin in the game and the least consequences for terrible decision-making. The biggest consequences for decision-making reside with the Ukrainians, obviously, and then the Russians, and then the Germans. And yet, for the Germans, Russians, and Ukrainians, all three of them, at least through their projection and perception, are all in response to decisions that are being made in Washington, D.C., where Washington, D.C. is like, heat it up, send the money, like the hotter the better, because they're not the ones that are getting jammed by the Indians for energy prices the way the Germans are. It's not their children that are dying in the mine, in the fields as the Ukrainians are, and it's not their children that are being drafted into the war like the Russians are. So it's always easy to be it's always easy for me to ask the two of you to fight because it entertains me, and give you guys weapons. But particularly from the German, like for the Ukrainians and the Russians, it's so existential. I don't know that there's even there's room for a discussion. The Germans are in a different business situation along with the Italians and I just don't mention the Italians as aggressively because it's a smaller economy. It's not as much of an industrial economy. I mean, Germany is the flagship economy of Europe. And I just think there's going to be increasing pressure, particularly because there's already been so many discussions around some version of concluding, of trying to reconcile, of ending the violence, going back to, a month after the war started. And it's been made so clear that the United States, above all others, is the one who says, along with the Ukrainians, who are like, listen, we will only negotiate when we have the leverage to control the term sheet. And until we have the leverage to control the term sheet, there'll be no negotiation. But again, you're gambling with other people's money, and those people are losing, and their patience will wear out.
Dylan, we only have you for a few more minutes.
That certainly creates
Sorry, go ahead, Ilya.
I'm saying I think that's certainly, there's no question that is a narrative that's out there. And we can debate its merits. We can talk about, Germany's terribly exposed to China also, and China is in terrible shape.
I know.
That's a knock-on effect, and this and this and that. There's no question, I think, that as in the U.S., there is emerging a contingent that's loud, that's saying, do we really need this mess, and do we have to be in it? And if there is a disengagement from it, that significantly changes the operational reality for everyone, and that significantly changes the market response. There, I think there's no debate at all.
Yeah, Dylan, we only have for a few more minutes because it's late from where you are. So I want to briefly talk about the China issue from a policy perspective, perhaps through the lens of politics here in the United States. Last night, my lobotomy was canceled, so I spent an hour plus watching the Republican debate over in Milwaukee. And the one theme that kept coming up through the incoherent mess that was so much of the cross-shouting and yelling was that there is a contingent of people, it could be Trump who wasn't there or any of the 8 people up on stage, who see China as the number one issue facing the country right now. Granted, I would agree on a lot of those points in terms of China being a major global competitor and having deep concerns about what they do with respect to Taiwan. But the Chinese economy is going through a property burst right now. Their debt bubble has gotten too big. I would think that the CCP does what it typically does, where it just shovels more money into a hole. That does mean capital is going towards unproductive means, lower growth moving forward. I guess my question to you is, from where you sit and stand, do you think that this is the big one? Is this when the Chinese property market bubble finally bursts and begins to end the Chinese growth miracle story that has, you could say, defined global markets for the better part of the last 20 years?
I mean, so for one, I agree with you. I'll say a few things. One, China obviously is the relevant counterparty. I've always felt that Russia was a distraction. In many ways, or it was either a distraction or some sort of the pressure on Russia was a backdoor to try to get position, posture, weaken something relative to China, depending on how, much credit or lack of thereof you want to give to America's foreign policy teams. But China is the obvious relevant entity. I feel like I'm skeptical of American economic data. Okay. I'm for sure skeptical of Russian and European economic data. I have no ability to really judge the Chinese economic data in terms of its overall consequence, other than that I tend to have faith in the absolute power of a massive government like that to intervene and do whatever is necessary to prevent the problems that they obviously do have in the real estate market from cascading into something that is politically destabilizing. I've always perceived China to be a country whose entire economic agenda has been based on creating some version of economic activity whose core principle is in the stabilization and employment of young men in order to ensure the political stability of the country. So it's not about what's the most growth we can get or what's the most innovation we can create or whatever. It's how do we create the most reliable, stable jobs for the largest number of young men to ensure social and political stability in the country, which I'm assuming will continue to be their mandate above all else, along with saving face, which is culturally central, such that they can navigate whatever this is, even if they have to do it the way that the United States navigated the issues of 2808 or 2009 with just preposterously large amounts of government capital.
One of my favorite statistics, this was in Fareed Zakaria's book, Freedom, a number of years ago. He pointed out how you go back to the 15th century, and the data is only collected from Western worlds, but people are people wherever you go. But you go back to the 1500s, 95% of violent crime is committed by men between the ages of 18 and 35. And so when China sees a large contingent of prime age working force males now out of the labor market because they can't find jobs or they're frustrated with their cultural or social situations, it can breed a period of political instability. And the CCP has really one goal, which is to make sure that it stays in power. Dylan, we're going to have you back here a lot over the next few weeks, hopefully. We'll drill down into some more of the specific issues of the day. This first appearance in overtime, we felt was good to bring up some of the big geopolitical issues that are facing us right now and get a lay of the land. And we can kind of use this as a signpost.
No, let's stay with it. We got to solve the Russia problem, the China problem. We didn't even get into the Middle East. I think we can solve it all.
Yeah, we haven't even talked Israel-Palestine yet. So how can we say we've made any progress?
That's right.
Exactly.
Everyone,
don't forget, anytime you mention Palestine and Israel, you have to remember there's the Egyptians are in there. The Egyptians are there. They always get off scot-free. But if they want, they could help if they wanted to.
Well, without pissing off everyone across the planet today, we should probably cut it short there. For Dylan Ratigan, I just want to say thank you for joining the show. He'll be back with us next Wednesday and every Wednesday moving forward here on Overtime, 4:30 Eastern, 3:30 Central on Tasty Live. Thank you so much for coming out on this late night over in Milan, Italy.
It's an honor and a pleasure. Nice to be with both of you. I look forward to it. I'll see you next week, all right?
Thank you.
All right, thanks. Thanks, Ilya. Thanks, Chris.
Ilya, as we wind down this show, this overtime episode, we should get back to the markets here. I put the euro up on the screen while Dylan was speaking when he's talking about the situation in Europe, because today is another bad day for the euro. It's another bad day for the British pound. It's a bad day for anything that really isn't the US dollar. Yields do move up. I wouldn't say as substantially as we've seen some moves in recent days and weeks. But the fact is that the market is looking at the very near-term horizon, and they're saying, we see a widening gap between what the Fed is going to be doing and what every other central bank can possibly do. British pound closing here at its new monthly low in terms of a closing basis. You're seeing this as well in the euro. The yen backs off a little bit today, too, on the other end of higher U.S. yields. The Australian dollar gets smacked lower. What's your lay of the land here? I mean, we see bond yields up, stock markets down, the dollar soaring. That is not a pleasant mix for most people.
The very pleasant mix for me, because this is, of course, exactly the...
I said for most people.
It's, of course, exactly the exposure that I have and exactly what I've been expecting. I think what really strikes me about all of this is that it has all of the makings of a higher for longer kind of vibe, but not exactly. And it's the not exactly that I think really has the key to everything that happens in this market today and probably tomorrow also. If you look at the relative performance of something like a ZT versus a ZB, what you start to see is differences in dynamics. You start to see that you have a much more significant responsiveness to higher yields at the short end and a much more significant support for bonds at the long end. You look at gold, it is not running away. It's not by any means soaring, but on a day when yields are up and the US dollar is up, gold is holding. And
good thing, though, for gold, right?
A good thing for gold, a telltale thing for markets. Because the story seems to be we're scared, and it's not just that the Fed is going to be higher, it's that we're scared about what that means. And there is a new dimension to it. Because if you looked at the way that risk aversion worked last year, it was rates are going higher, that's bad for stocks, it's bad for gold, it's bad for bonds, it's yields steamrolling everything. Because the economy was doing fine. Because the story was about making it more expensive to take risk, to bet on markets. It was a drive up in borrowing costs. This is now the land of consequence. We have Europe that's in recession, China that might as well be if it lasts that long, because if there is some sort of meltdown, then it might go straight from being in something like a precarious slowdown to being an outward crisis. It might skip the baseline recession step if something cracks, but certainly is in very dire straits. The numbers that we're getting out of the U.S. on the PMI side of things, weaker than expected. So what that's telling you is that while we may be looking good for the third quarter, and I think even just the retail sales numbers say it, so that much is clear. But when you look at the PMI numbers, which are more forward-looking, and look beyond where we are now, 3 months, 6 months, 9 months, just in terms of their perspective, they don't look great, although they look better than everywhere else. And the Fed is aiming squarely at that which is holding up the U.S. economy, because their job is to squeeze out inflation from the labor market, and that means hurting consumers, and 70% of U.S. growth is consumption, and there is no growth but U.S. growth at this point. So if you look at that all together, you start to see why gold might be holding now, why the long bond is holding up, but ZT is down. It starts to all line up. If you look at where the yen is today, it's weaker against the dollar. It's weaker against other currencies also as a knock-on effect, but much less so. It is holding up much, much better elsewhere, which again speaks to this risk aversion situation. So you take all of this together, and the difference seems to be that now the markets are prepared to hear what the Fed is saying. And this is not unusual at all. Markets ignore things and then don't ignore them all the time. So I don't think it's that Powell's going to say anything different. I think there's a recognition in markets that he could not offer a lifeline. And that would mean the current status quo stands, and we're ready to worry about that.
Last year at Jackson Hole, the problem was that Powell told everyone that more pain was coming, and that really spooked everyone. Yeah. It's worth pointing out to people, and a former colleague of ours was tweeting about this today. He was noting how, Powell said more pain was going to come, and then stocks bottomed 6 weeks later.
Yeah.
So what does pain mean? Do we think that Powell and co are going to have that kind of impact on the market? The pain comment really shook people last year.
Yeah.
Is there a rabbit like that he could pull out of the hat right now? Quite frankly, because, even if you're looking at the 5.9% expected growth rate for the third quarter, most people will tell you, we've told you, it's a nice number to look at. The economy's running hot. It's data mostly through July. You don't take the numbers seriously until you get into late September, really early October, if you want to think about it. And then it becomes a much more accurate reading the week leading into GDP, which will be the final week of October. We're still 2 months away from that being a possibility. Why would Powell and co put more weight on that right now? He's already said that the R-star doesn't matter to him as much as it does to other policymakers. I mean, I keep trying to get into this. I've been saying for months, check the scoreboard, the economy's doing better, so the Fed can go higher for longer.
Yes.
But if Europe catches a cold, this isn't like 2008 where, Europe catching a cold means, or sneezing means, the United States catches a cold and vice versa. Economies are much more intertwined now. They're much more interrelated. They're much more codependent. And so if China's going down, Europe's going down, Powell just may look at this and say, there are some bumps in the road right now. We see that inflation has a chance to go up here the next few months. Growth is accelerating, which raises the odds that inflation can stay elevated the next few months. But once you get through January this year, the base effects start to slide off. And all of a sudden, China and Europe going into, China's dealing with a debt problem that takes a long time to climb out of, means substandard growth, subtrend growth, at least for not just Chinese standards, but global standards for a prolonged period of time. Europe going down likely means weaker trade with the United States. So Powell may say there's deflationary forces in the pipeline, right? We see both sides of this. I just see him ending up at the point, no matter what roads he takes there, he's going to end up at the location of we're data dependent still, like we've been saying for weeks and months, and nothing has changed with respect to that. So where's the direction then? I don't find myself looking at the charts and the options market right now saying the market thinks this is a seminal turning point. Mm-hmm. It could produce a good deal of volatility intraday. But by the time we settle things out, we may just be back where we started.
So that we saw the sell-off today, I think significantly actually reduces the chance that we get a further explosion tomorrow. I would have actually preferred that all of this happened tomorrow.
I agree. If we had gone up big today, then the odds of a big swing tomorrow would have been much more significant. Now you're looking at the weekly charts when we pop it over to ES and, they're not really
an ugly day.
It's an ugly upper wick, but we really haven't moved anywhere this week now.
Right. No, it's an ugly day any way you slice it. And I think had we had a better day, maybe the chance for something really brutal tomorrow was higher. My thing is this. I don't think he has to say anything that's any different, because I think the difference isn't what he says. The difference is how the markets interpret what he says. And when you have an NVIDIA earnings report in front of you and you're like, it's okay. They'll report a good number. We'll be okay. You don't have anything at this point. There is nothing to hang the hat on. There are no more straws to grasp. You now have to reckon with the fact that the Fed isn't kidding. The other thing here is, this is not going to be the other kind of conversation that we're going to get at the September FOMC, say. It's not going to be the kind of conversation where the Fed goes, well, there's this factor, and we're looking at this, and we're looking at that, and here's how that might impact near-term policy. That's a policy statement. It's a post-policy statement kind of a press conference sort of speechifying. Jackson Hole is different. It's more academic. It's more abstract. I think all Powell really has to do is say that which you have been saying. The Fed doesn't care what the rate is. The Fed cares what inflation is and what employment is. And if that's what the Fed cares about, well, it's not where it needs to be on inflation, and it isn't going there anymore if you look at market expectations. So if the trend in expected inflation is broken, then the Fed isn't doing its job, and it has to fix it. That's very simple. So what Powell has really to do is to assert that idea that, look, just because we're up to 5.5%, 5.25%, and before that we were at 2%, doesn't mean we have to go to 2%. It means we need to be wherever we need to be, so inflation is going to 2%. That might be 4%. That might be 3%. That might be 5%. All that the Fed has to do, because the markets really want this out. They want the lifeline so bad. And the pain trade, which is the correct thing usually, is that the Fed goes, you're not getting it. Not that we're going to hit you harder. We don't know. Maybe we will. Maybe we won't. But if inflation isn't trending to 2%, you are not getting any relief here. And in my mind, that's enough, because the markets now have a global growth backdrop where that's a really scary thought.
Ilya, I still stand by my comments from yesterday that I see markets unfolding a little bit of a sine wave. I was feeling a little bit optimistic yesterday that we could be looking at the upswing in that sine wave. Today, outside engulfing bars in NQ, ES, YM, RTY, everywhere you look, SMH.
NQ was lower than it was before NVIDIA.
That is true. And it's wiped out basically all the gains for this week. Head and shoulders patterns may be forming.
Yes.
These would be more significant topic signals. If you look at ES, you look at NQ, that would suggest that there are hundreds of points, in NASDAQ's case, potentially thousands of points open to the downside. Mm-hmm. The way that you trade those is you wait for a neckline to break. We're not quite there yet, so let's not get ahead of ourselves. But when we plot out different paths, if you're a technician looking at these markets, you have to be open to several different possibilities. If we follow, go through door one, what could be behind there? Well, if we go through door one and we fall below 14,500 or so, and we lose the uptrend off of the January and March swing lows, and we break our neckline here, door A probably leads to much lower prices over the next few months, a more significant correction in this market. If we can't break through that neckline and we continue to treat that area near 15,500 as resistance, a level that we kissed here today, that band that was resistance back in June, early July, became support through the middle of July and held us up there ever so briefly at the start of August. If we can't break through there, then door B, door number two, that's probably going to be range trading. And if for some reason we trade back above today's high, well, then the reversal candle's been negated, and then the path to returning to the yearly highs opens up. That's door three or door C. What kind of numbering convention are we using here? We're going back and forth. It doesn't matter.
Let's go to Roman numerals. Why not?
Perfect. So if we get through door III, then we find ourselves in a more bullish outcome. But the fact is, you have to have your different scenarios planned out here.
Sure.
Quite frankly, when I look at this market and the pricing, do I see last week's low or this week's high being broken around the Fed? That is the question. That is the trade question heading into tomorrow. And I think given the pricing in this market, we could say the answer is no. I think about the high for today coming in at 15,418. I think about the low from last week, 14,609. We pop on over here to our trade tab. We take a look at our effectively zero DTEs. We put on a little bit of an iron condor here. We're going to blow this out. Let's blow this out to where the lows were. We'll put you down here and we'll move you back out there. Just work with me for a second, Ilya. But you can see as we begin to construct this potential trade, and let me just double check, confirm I have my numbers right, 15,418. Okay. You can see here that the market is effectively pricing in, as it were, if you were to do an iron condor, the put spread down at 14,640, 14,660 on the strikes, and then the call spread portion of it, 15,000 short call, and then 15,020 long call. 55% chance that we stay within the weekly high-low range, or at least last week's low and this week's high range. I think that's right. I think that may be the trade to play for that. The market could move a whole bunch tomorrow, but will we see the monthly lows taken out or the recent swing high from just even today's session? I think the odds are against that. And expecting a significant directional move, expecting the NASDAQ to break 500 points tomorrow or S&P to break another 40, 50, 60 points tomorrow, that would be a move outside the expected price bands. And so at least through the end of this week, yeah, Powell can say something. It's going to have to be deviant from expectations. The market's already fairly hawkishly positioned. Again, we're above 50% for a rate hike in November. Rate cuts been pushed back to June. Bond yields are up near yearly highs. The 2 years knocking on the door of 5%. So how much more hawkish can we get? Sure, he's going to speak in hawkish terms. I don't discount that. But hawkish enough to dislodge us from recent high and lows? I don't know. I don't think so. And so I think tomorrow the play may be just look to the high, just look to last week's low, and let's play ping pong between there. Good old-fashioned game of Atari.
The only, and I think, again, after today's sell-off, it's more likely, especially, say, if you look at NASDAQ here, that you're going to hold something like 14,700, let's say. You're going to probably, you might hold the low here at 14,600 even. That's the low from last week. If you close under the low from last week, or if you break, let's say, 14,700, and you just issue a daily close under it by the end of the session, That would not be a stretch at all here. That would be a mere 200 points from here on the NASDAQ. And the change on the NASDAQ today is 330 points. So let's say we close, I mean, we're essentially closed now on the cash index for the futures, let's say 14,860, 14,862.
That's what I have.
On the continuous contract today. So from here, let's say you want to close 100 points lower, 200 points lower. Let's say 150. Let's split the difference. You close down 150 points lower tomorrow, which is not a big move relative to recent swings. And you've broken a key level and set a major top. So it doesn't all have to happen tomorrow. It just needs to have a bit of follow through to tomorrow. And all it really has to do is have a degree of deflating optimism in markets into the end of the week where they go, man, we thought he was going to tell us that good, this rate hike cycle worked, didn't kill the economy. We're here in the final stretch. Now we're just going to fine tune this thing. He didn't say any of those things. He just gave us the same old right from the FOMC minutes in July. Pain, 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 inflation, inflation, and inflation. He didn't throw us any kind of bone at all. That might be enough. Powell need not actually hit anybody over the head with anything. He just needs to continue to be indifferent to the pain and suffering of risk-on investors. That indifference might be enough for another 100 points, 150 points in the NASDAQ. But if that occurs, momentum might well carry you forward from there. That's probably an ugly close for Asia, which is going to open on Sunday looking at where Wall Street finished Friday and going, they did what now? And that has follow through. Then Europe. And then free fall. Now, it need not happen that way. But you don't need the big tectonic Powell comes out, slaps the proverbial market across the face and goes, I will hit you so hard for the next 6 months. And the market goes, oh my God, he's not anything like we thought he was. That doesn't have to happen. He just has to be indifferent enough that their fears are made real. And that's really it.
Ilya, if we see the weekly candles play out as they are shaping up to be right now, the kiss of the backside of the trend line off the lows that we see from March and May here in ES, if you're looking at the continuous contract or the U3, you see the rejection of that former 4480, 4500 zone. This looks like a failed attempt to take back control of the uptrend, plain and simple. Yep. Forget the narrative, forget the Fed, forget China, forget NVIDIA, forget, Putin assassinating one of his former allies in broad daylight, which is a clear warning signal to anyone else who wants to step out of line in Russia. And we're not in Russia, so I will continue to step out of line here in the United States. I would say that being ticker agnostic, this looks like a market that wants to go down now.
Yeah,
plain and simple. We'll see if Powell and co can resuscitate and give bulls hope. If not, look, those head and shoulders patterns, they haven't broken their necklines yet, but it's starting to look like they're beginning to come together. We don't trade them until the necklines are broken, folks. They could just be sideways distribution patterns. They could be continuation efforts. We don't really know yet, but now the odds are beginning to tilt into, hey, maybe this market needs a little bit more pain before we can reassert. And to reassert ourselves on the uptrend off the swing lows that we have last year, well, for the S&P 500, that comes in below 4,300 over the next several days and weeks if we take a look at our charts. Ilya, you and I could go on for a lot longer, but we mustn't because you have to go on for a little bit longer here. As it were, we like to say here on Overtime, we're now out of time. To follow Ilya, you can do so, of course, on Macro Money, 5:30 Eastern, 4:30 Central Time every Monday through Thursday, which of course is preceded by overtime. 4:30 Eastern, 3:30 Central. He's also on First Call with Tom and Tony Sunday evenings, 5:55 Eastern, 4:55 Central. You can find Ilya on X at Ilya Spivak. You can find me on X at CVECUFX. Futures Power Hours every Monday through Friday, 1 p.m. Eastern, 12 Central Time. Ilya will be there tomorrow to do a post-Jackson Hole breakdown with me. Be sure not to miss it. Of course, Let Me Explain is on Tuesday mornings, 9:40 a.m. Eastern, 8:40 a.m. Central. Until then, good luck trading. Up next, Macro Money with Ilya Spivak.
See you there, everybody.